Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. I'm Harry Gibbon, investment manager based out of our London office, and I'm joined by podcast regular Richard Carter, head of fixed interest research, and Ben Barringer, head of technology research and investment strategist. Welcome both. Last week was a quiet week in terms of economic data, but this week seems a little bit more interesting. Over the weekend, the US and the EU made a trade agreement to stave off a trade war. If they hadn't made a deal before Friday this week, Trump was threatening 30% tariffs on all EU goods. As a reminder, Trump put a pause on all tariffs until August 1st, so the last day for countries to make a deal is Friday this week. At the moment, the US has made deals with Indonesia, Japan, the Philippines, the UK, and Vietnam. Richard, could you take us through the specifics of the deal the US and the EU have just made?
Yeah, I think there's still a few details to be ironed out, Harry, but broad brush is that the EU is going to face 15% tariffs on exports to the US, and they've agreed, like a bit like Japan did, to basically make various purchases of energy and energy materials from the States and arms and all the rest of it, and also open up their markets for US exporters. So it does seem a little bit of a one-sided deal in favour of the States, but I think the EU was concerned about what the alternative might be. Obviously you mentioned potential for 30% tariffs from August the 1st, and I think also at this current time, particularly what's going on with Russia and China, with Ukraine, it wouldn't really be a good time for the EU and the US to fall out. And I think they basically put sort of relationships with the Americans first. There are still more details to be sorted out in terms of steel, pharma, because there's other sort of sectoral investigations going on to then. But yeah, it seems to be it's a good step in the right direction, I think, particularly coming on the back of the agreement reached with the Japanese.
Are these investments real? This promise to buy X $100 billion of energy, to buy vast amount of military equipment. Would these countries, would Europe and Japan have been buying these sorts of products anyway?
Someone called it theatrics. I think that's probably the best way of summing it up. It looks good for Trump. I think these purchases probably would have been made anyway. Maybe they're a bit more locked in stone. Certainly the EU needs US energy goods, and imports, because they don't want to be reliant on other countries like Russia. The military one's a bit less certain, because the whole idea, it seemed to me recently, was that the EU was going to become more self-reliant. So here they are now buying more US military hardware. But I suspect, as I say, it probably was going to happen anyway.
Yeah. And, we mentioned the August 1st deadline here. To the listener, it might sound like only a handful of countries have really come to Trump and have a plan to start next week. Is there a bit of a concern? Is there a bit of a cliff edge coming if more countries don't come to the table this week? And is it even possible to put a plan together by the end of this week?
I think there's a chance that some countries face, sort of higher tariffs, but, it may be that deadline gets rolled once again, and we're kind of fairly used to that. I think markets now, though, are less concerned. You've had, obviously, the UK do a deal, the Japanese and the Europeans. So that's really some big economies kind of sorted out and a bit more clarity provided. You've got the other really big country, China. That's on a slightly different kind of Trump style rolling deadline time frame, and negotiations carry on in the background between the US and China. So that's still a big concern, but I don't think that's going to blow up this week, because the deadline actually on that one isn't until mid-August.
I'm surprised his ego can handle all these acronyms that are coming up, like TACO. I can't remind me, Richard. What does that stand for?
Trump always chickens out. Yeah, I think he's not too happy about that one, but so far it's probably proven to be pretty much correct.
Yeah. So on top of the usual tariff talk, this week we have some central bank meetings in the US and Japan, as well as Eurozone inflation data. All of these may be overshadowed by the end of Trump's tariff extension on Friday, but nonetheless still very important events. What are you expecting from the Fed and the Bank of Japan this week? And should we expect any surprises from the EU inflation data?
I think the Fed, it's interesting because obviously Trump's putting enormous pressure on Jay Powell to cut interest rates, even turning up to inspect the building works at the Federal Reserve, which was pretty strange. The Fed's not going to be cutting rates this week. There might be a couple of dissenters to that, maybe jockeying for position as the next Fed chair when Powell steps down. But I think for now they're basically on hold and they want to see what the impact of the tariffs is on inflation. So that's probably going to be roughly a non-event. No doubt Trump will be tweeting or whatever he does these days afterwards in fury that the rates haven't come down. Probably same in Japan. No change expected there this week. And then in terms of the other things, European inflation data actually it's pretty benign at the moment, in contrast to particularly the UK. Although the ECB last week was saying we're getting pretty much to the end of our rate cutting cycle because they expect maybe growth to pick up a little bit. But yeah, it's quite a big week. You also got non-farm payrolls out as well. I think with the sort of some of these trade agreements being done, the focus now is going to shift to what's the actual impact on the economic data and what does that mean for the Fed? Because so far, there hasn't really been much impact that we've seen on the data, but that may still lie ahead.
Yeah, absolutely. Thank you, Richard. Ben, I'd like to come to you now to discuss a few of the companies under your coverage. We are coming into earnings season for Q2, and technology stocks tend to be one of the earlier sectors to report. You've had companies that play a significant role in the supply chain of semiconductor chips, TSMC and ASML, which had a slightly differing set of results. Could you just remind the listener of what they do and tell us what we can glean from their results as to the demand or even supply of semiconductors?
Yeah, thanks, Harry. TSMC, Taiwan Semiconductor Manufacturing Company, is the biggest producer of chips in the world. So your iPhone will have, not just one, but many chips from TSMC inside, including the key processor, core applications processor. So we watch them very closely. We invest in them, and their revenues last week were up 44% year on year. Very strong performance, and that's principally driven because they do the manufacturing for NVIDIA, but also AMD and Broadcom and a few others as well. So high performance compute, these AI chips, is very much driving revenues at TSMC, and they also up their guidance from 25% to 30%. So very strong growth from this business. And then if you think about Taiwan Semiconductor, one of the biggest risks that investors face is the invasion of Taiwan by China. And so they did quite a lot, or have been doing quite a lot, to diversify their manufacturing footprint. And they gave us some good detail on this, I think. They are going to have 6 fabs of their new fabs in Arizona in the US. And they're going to have 2 in Japan, and they're going to have 1 in Germany. So that's 9 outside of Taiwan. At the same time, they're also building 11 in Taiwan. So think of it, that's 45% of their manufacturing capability or new capability will be outside of Taiwan. So I think that's quite encouraging from a sort of diversification perspective. That's not, and those fabs that are outside of Taiwan are not just, older technology fabs. 30% of their latest or the next generation 2 nanometer chips will be coming from Arizona. So that was pretty good. The only sort of thing, they're being quite conservative in terms of their sort of outlook, and they're also being reasonably restrained in terms of their capex outlook. Their capex will be up 35% this year, but they didn't raise it despite the upgrade in their guidance. And so that then cascades neatly into ASML. ASML's biggest customer is actually TSMC. So ASML makes the machines that make semiconductors. In fact, they make the lithography machines. Now, lithography is essentially the technology that allows you to print smaller and smaller chips, if you will, reducing the font size of the chip. And that's important for Moore's law. Moore's law, the thing that drives, lower cost, higher performance chips over the last, more 60 years, 70 years. So that's a key driver. So ASML are absolutely one of the key providers to the semiconductor industry. Now, they saw some very good growth, 23%, but they have talked about slightly less certain growth in 2026. In fact, the possibility of no growth in 2026. And they blame macro and geopolitics and tariffs. I think about it slightly differently. I think they have some issues in China. China has been a big driver of demand as they try to build their own semiconductor industry. Obviously, with tariffs and restrictions, that's an uncertain and I would call lumpy demand area for them. Secondly, memory is a little bit of an uncertain place. Will the memory industry grow and increase capex or not? And then finally, and probably more importantly, is that TSMC have increased their lead over companies like Intel and Samsung. And so it used to be that ASML had three very healthy customers in TSMC, Intel, and Samsung in logic, in processors. Now those Intel and Samsung are sort of slightly falling behind, and so their futures are a little bit less rosy, and that obviously impacts orders from ASML. There's one other thing that's slightly technical, Harry, which is that there's a change happening in the architecture of how processors are made. A thing called gate-all-around. Think of this as more three-dimensional chips. So think of this as building more stories in your house rather than just a bungalow. You're building a two-story or even a three-story house, and that means that you need less technology that shrinks the chip and more technology that builds the chip up vertically. So you need more deposition. That's a transition that's going to take probably a year, 2 years to flow through. So that basically means less lithography is needed in the short term. But look, ASML, a high quality business, but it's facing a few headwinds at the moment. And so that sort of explains the difference that TSMC had very good results that were received quite well. ASML is a little bit more uncertainty. If you will, ASML is a play on the capex of TSMC, and as I say, capex at TSMC is being held flat at the moment, but it's still a very high quality business, ASML.
Yeah, really interesting, Ben. It's sort of Chinese demand has been certainly affecting a lot of sectors. It's not just yours, from luxury European goods, even to China sector pharma. It's interesting that TSMC are only building, or their sort of end result is having 50% of their fabs outside of Taiwan. Do you think that? Because if I thought that China were going to invade and my company was going to be hugely impacted, I thought maybe I would weight my external or overseas fabs higher than my current fabs.
Yeah, so look, we've come from, it's all about relativity, Harry. We've come from a position where they had virtually no fabs outside of Taiwan, and the reason that they have them all together in Taiwan is you get incredibly good synergies by having fabs all together, because what is required is what's called an ecosystem, right? So it's not just having a fab there. You need the people, and you need the water and electricity infrastructure, and you need all the suppliers, and you need an ability to have multiple fabs next to each other such that you can manage capacity utilization. You can get much more efficiency. So there is huge amount of benefit of having a concentrated footprint in one country, and that's very much what TSMC has built up in Taiwan. Now this is an acknowledgement that they need to diversify, and I expect in the future that maybe that 45% number will increase. But what it's really doing is sort of saying to the Chinese, we got capacity in other places. Let's say, for example, that China invaded Taiwan tomorrow. All of that capacity in Taiwan was destroyed. It would have to be built somewhere else, right? And so they, if you will, they're sort of front running that and trying to diversify. But there's a trade-off between how much you diversify into different countries versus having the critical mass, let's call it, in certain countries. And Arizona is certainly what they're describing as a supercluster, and it also, obviously plays to Trump's reshoring of manufacturing into the US as well. Now, it should be said, Samsung is also doing a similar thing, not to quite the same extent, but they are diversifying. But Taiwan Semiconductor is still a Taiwanese company, so they've got to have some stuff in Taiwan.
Absolutely, yeah, really interesting. Now, in the wider world of tech, a lot of the large US technology companies are reporting. We've had Alphabet and Netflix report recently. But this week, I think you've got your work cut out for you. You've got Meta, Microsoft, Apple, and although Amazon's not under your coverage, that is also reporting. What have you learned from the Alphabet and Netflix results? And is there a theme that you're expecting from the Meta, Microsoft, and Apple results?
It's a great question. So yeah, look, let's take Netflix as the simplest business that continues to produce very good sort of mid-teens kind of growth, and all they have to do is grow content spend slower than their top line, and they get massive operating leverage. The biggest impact actually to Netflix was FX. Like, there's been a big move down in the dollar. That actually benefits Netflix on a reported basis, because a lot more of their revenues are outside of the US than they are inside the US. And so FX is the first theme I would point you to. In terms of the Google results, themes to come out of that, I mean, the digital ad market remains very strong, and that's obviously going to help Meta, and there's also an advertising business within Amazon as well, and in Microsoft as well, but it's a relatively small part. So the digital advertising market remains reasonably robust, and that's being helped by generative AI, helping to improve experience for users, but also helping to improve targeting for advertisers. So that's the first thing. Second trend from Google's results was that they have upped their capex for cloud spending and growing their data center footprint. So that's gone up from 75 billion to 85 billion. And we could well see upgrades from Meta, from Microsoft, and from Amazon this week in terms of their data center footprint. Apple doesn't have much of a data center footprint, so we don't need to worry too much about that. So the capex would be probably the sort of the third trend. And then obviously, just the final thing you have to talk about Google is, what's going to happen with the DOJ investigation. That's probably going to read out, or some of the remedies are going to read out in August. We see that as a bit of a threat to Google. We don't quite know what the remedies are, but it could be very disruptive to their position at a time when their core business, search, is being disrupted by ChatGPT. I don't need to, most of our listeners will know that, people's usage of ChatGPT is increasing while and probably their use of Google search is decreasing. And that is a clear disruptive threat for Google that has an 86% market share in search. So that's the Google piece. Yeah, as you rightly say, $11 trillion worth of market cap is reporting this week. We've got Meta and Microsoft on Wednesday. Expect ad growth at Meta for about 17%. Again, focus will be on capex and OPEX, their operating costs. For Microsoft, the key focus is going to be on the Azure growth. So that's their cloud business. That's expected to come in around 36%, something like that. So that's the bogey for that one. Amazon, we'll just briefly touch on, again, looking at the e-commerce profitability and AWS growth. And then Apple, finally, been a bit of a sort of a quiet cousin, has Apple. I mean, basically, the focus for most investors at the moment in tech is on what's the AI opportunity for all these companies. Apple has actually struggled with the rollout of its Apple Intelligence product. Essentially, it's trying to make Siri better by giving it sort of more generative AI functionality. It has struggled with Apple Intelligence. The reason that's important is because Apple is a replacement cycle business. Smartphones are largely a mature business, grows at 3 to 4%. But what really helps iPhone sales is when people have a reason to must upgrade to the next phone. Apple Intelligence was seen as one of the reasons to upgrade, but with that being delayed, that's delaying that upgrade cycle. And so we still see Apple as an underperformer, as it has year to date. So yeah, look, we like Meta, we like Microsoft, we like Amazon. We're less keen on Google and Apple and Tesla. Oh, and we like NVIDIA, but they don't report for another 6 weeks.
I'll leave that to your podcast in 6 weeks, I imagine. Well, thank you so much for those insights, Ben. One of the interesting things, the sort of anecdotal bits from Netflix results is that it remind me how long it takes someone to find a show they want to watch on Netflix. Is it?
20 minutes is the
Yeah.
average. That we probably are about in line with that in our household.
Yeah, so I thought we were just indecisive, but clearly as a nation or a planet, we are all indecisive.
What's that joke, Harry? I used to be indecisive, but now I'm not so sure.
Exactly. There you go. We'll leave it on that then. Thank you very much, Ben and Richard, for your insights across a wide range of topics today. Before we draw to a close, if any listeners have any questions they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltachieveit.com. Here you can also see more of what we are doing at Quilter Cheviot, as well as watch past webinars on demand and subscribe to our weekly comment newsletter. We'll be back again next week, and in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. Thanks again to Ben and Richard for both their time today, and thank you all for listening.